It's called the SEP, the Summary of Economic Projections. That's where all the forecasts are. Inflation, unemployment, growth. You'll find the dot plot there as well. Lisa, after that, it's over to the chairman. 30 minutes later, a news conference with Chair Powell.
And basically, we do not speculate, we do not guess, we do not assume, but at the same time, he's going to be asked, what are you basically modeling out? What is your response function? How inflationary could some of these policies actually be?
I use Kleinman moving averages as intermediate moving averages, 9-unit. It's out to a new high on the DXY. If you get a dollar breakout higher, Mr. Trump will pay attention to that. Mr. Bissett will pay attention to that. And even Ellen Zentner will pay attention to that.
I've got to say, TK, I'm pleased you brought this up. How NUKK responds to this in the minutes and hours after this decision, I think will be pretty interesting.
Especially because it's a two-part act there. On one hand, let's go. Let's get the engines revving up. On the other hand, inflation's the reason why Joe Biden lost. That's what a lot of people believe.
I spent 20 minutes before this using the Bloomberg. I even got to Hungarian forint. John, I know your place in Budapest. You cared about that.
Last year, I think down double digits against the dollar.
Yeah, for separate reasons, it really popped, but it's worth watching EM here.
Welcome back, TK. I've missed these conversations.
Well, it's just
going out there, bring up Hungary. Do you remember those Swiss franc mortgages all those years ago?
Yeah, the Swissy foreign mortgages.
Who would have thought we'd be talking about this 50 seconds out from the decision? But that was a real thing. That was a problem in the day.
Actually, right now, there are nodes of that happening in different places. And check out what's going on in Brazil.
Let's hope that Brazilians haven't been taking Swiss franc mortgages, because they've probably been in a lot of trouble after the performance of that currency this year. Let's turn to the scores. That decision is 30 seconds away. Equities on the S&P 500, positive by 0.2% on the S&P. Some outperformance so far this afternoon on the Russell. The small caps up by 0.65%. If you switch up the board and get to the bond market story, check out the yield curve. We'll slice this up on the 2s, the 10s, the 30s. Yields are coming down at the front end of the curve by about 3 basis points to 421.30. On a 10-year, we're down a single basis point to 438.29. With your Federal Reserve decision, the overwhelming consensus saying a 25 basis point cut. Here's Mike McKee.
It is a 25 basis point cut, and the number of cuts forecast for next year has been cut in half to just 2. Another 2 are seen in 2026 and 1 in 2027, and as the long-run Fed funds rate expectation rises to 3%. If that's basically seen as Fed officials' view of the neutral rate, they won't get there under this dot plot until 2028. We have one dissent. New Cleveland Fed President Beth Hammack casts her first, preferring to leave rates unchanged. Interestingly, 3 other members of the committee, presumably non-voters, agreed with her. 10 members see two cuts next year. 5 see 3 or more. 3 forecast 1. And there's 1 member who thinks optimal policy would be to leave rates unchanged all of 2026 and 25. There is only one change to this statement. They now promise to carefully assess incoming data, quote, in considering the extent and timing of additional adjustments to the target range for the federal funds rate. There's no change to the committee's view of inflation, which has, quote, made progress toward the committee's 2% objective, but remains somewhat elevated. The new economic forecasts, however, show both PCE headline and core inflation forecasts revised up significantly. Headline will be 2.5% at the end of next year, up from 2.1% forecast in September. The core also 2.5%, up from 2.2%. They do see unemployment at 4.3% at the end of next year, which is down 1/10 from September. The economy will end this year with GDP up 2.5%. That's a 0.5 percentage point jump from their September outlook, and it is going to grow 2.1% in 2026, a significant slowdown. In one technical note, the Fed did lower the offering rate for overnight reverse repurchase agreements by 30 basis points to 4.25%. That's the same as the Fed's target range lower bound. Guys?
Mike McKee, thank you, sir. There's so much to unpack here. So let's just go with 2025 and go to the forecast. So we get a 25 basis point cut. And then they do this for 2025. GDP revised higher. Unemployment revised just a little bit lower. Then go to PCE. Once again, revised just that little bit higher. So what do you get for the dot plot? The median dot was actually pointing towards 4 cuts for 2025. They've cut that in half to 2. which basically marks the whole thing to market. This is where the market was, looking for 2 cuts in 2025, and this is what the Fed is projecting, if you consider this a projection in the median dot. Turning to the price action off the back of this, we unlock another dose of dollar strength. Euro dollar breaking down to 104.44 off the back of that move in the bond market, with the yield higher at the front end of the curve on a 2-year up by 3 basis points to 4.28, on a 10-year up by a single basis point to 4.41. In the equity market off the back of that, we come off session highs. On the S&P 500, we are just about unchanged. So if you are just joining us, welcome to the program. It's a 25 basis point reduction from the Federal Reserve with a sprinkle of dissent and some big changes, Lisa, to the forecast for 25 and beyond.
And what you can see is basically the market readjusting, but not necessarily a freaking out. I think it's fascinating, the idea that Beth Hammack, the new Cleveland Fed president, is the lone dissenter. 3 non-voting members, as Michael McKee said, seem to have agreed with her. To me, this is the definition of a hawkish cut. We now have 100 basis points of rate cuts since that September meeting. Now they seem to be only baking in 2 rate cuts, as you said, and it raises a question of what the parameters are, what the messaging will be from Fed Chair Jay Powell.
Compare the September forecast to the forecast we just got. Where they thought Fed funds would be at the end of next year is now where they think Fed funds will be at the end of 2026. They've pushed the whole thing out 12 months. Now, the debate we're going to have, and no doubt the debate they'll have in the news conference with Chairman Powell and the journalists, how much of this is about realized data, the data we've had since the September meeting, and how much of this is about assuming, speculating, guessing what's about to happen with policy?
Well, and ultimately, how much can they divorce the two if they're looking for signals from the collective betting agency, the collective wisdom of the crowds of markets? At a certain point, they have been following the market in certain aspects, and in this case, the market is inferring certain things about policies, and the Fed cannot ignore that. But I want to hear from Fed Chair Powell this afternoon in just about 25 minutes' time. What is your scenario analysis? How do you take into stride the prospect of both tariffs as well as potential changes to immigration?
To me, the character of the dissent's interesting. I don't have time to study it, but the uniqueness of, she's quantitative economics out of Stanford. She certainly knows her way around the block, but that's something. Your first meeting and you dissent? I mean, what would Alan Greenspan say to that? That's like Lawrence Meyer 101. But the answer here is the markets are moving. I'm looking at yen out to a 154 level. Damien would look at it 8 different ways, but the answer is this is not a snooze fest, and there's a lot going on here in a more than expected hawkish cut.
If this is what they call a hawkish cut, I could not agree more. And that's judged by what's happening at the front end of the curve. Even as they reduce interest rates by 25 basis points, the 2 years higher by 7 basis points. We're back through 430. Bob Michael at JP Morgan's had some time to go over the statement, to go over the projections and the market reaction. What do you make of this one?
Well, I think they have an incredible sense of self-awareness that the economy looks great. The fourth quarter is going to come in around 4%. You've got unemployment at 4.2%. They'll take the side of it that says that's a pretty good level to be at. Inflation's a little bit above their target. What's the rush to keep cutting rates? Let's just back up a little bit. I think also they do have to listen to what's being talked about at Mar-a-Lago. And there is a lot being talked about. Not any of it is going to be disinflationary or a headwind to growth. And they have to begin to model that in. I actually think they did the right thing. I'm pleasantly surprised they went to 2 cuts next year instead of 3. We'll see what happens.
And do they model in, does the Trump administration model in his behavior, his statements on strong dollar that we saw, I don't know, 8 years ago, whatever the math is? Or is there going to be a different discussion about the efficacy of a strong dollar for President Trump? He's going to demand a weak dollar, we got to have exports up, or is there new behavior?
I think that's something we're just going to have to wait and see. I think there's still a view that the exceptionalism of the dollar is another one of these things that's potentially over-invested in. And suddenly, if you see policies coming out of the administration on tariffs that aren't as severe as expected, then you're going to see a lot of the foreign economies, a lot of the currencies and bond markets start to appreciate a bit.
Do you think that it was a mistake, and essentially this is the Fed walking back what Fed Chair Powell said about we will not welcome any further weakening in the labor market?
I think there's some of that, and I think they looked at the totality of the data. I started by saying when they look at everything, it's the perfect soft landing. They're looking for a resting spot. They don't think it's 3 or 4 rate cuts away. They think it's somewhere around 2 more rate cuts away.
Do you think that it's good that there's more dissent now at a time when there is so much dissent and disagreement just about understanding where we are currently?
I love it. I think it's ideal. You heard the conversation with Ellen. She's sitting there looking at things are about as perfect as you can get them. I tried to point out housing, and she smacks it away. And I think that's what you're getting at the Fed, which is, you know what? Inflation's a little higher than we want. Growth is a little bit firmer than we thought. The labor market looks pretty healthy. And by the way, has anyone talked about holiday sales? The consumers looked pretty good. What are we doing cutting rates further?
I look at this, John, and of all the things moving across the Bloomberg launchpad, Canadian dollar is extraordinary. We're not near a 144, but it's a jump condition, unlike others which are just pushing up as well.
They've got their own Trudeau-shaped problems, Tom, and Europe's got their own problems too. Euro dollar right now breaking down to 104.20, just about holding on now to a 104 handle. There's one question I've got for you, Bob. It's a forecast we haven't talked about. The longer run dot, it has inched up by like that much, from 2.9 to 3. Is there not a bigger realisation going on at the committee that needs to come up a whole lot more? Why is this taking so long to draw that conclusion?
Yeah, I think the realization is setting in, and I think having a dissenter on board is going to help drive that conversation. But if you step back and think where 3% is relative to a few years ago, that does seem pretty high. We had negative real Fed funds rates for a long period of time. The very first dot back in 2012 was 4.25%. Now we're right about that 4.25%. Why not just sit there and say, we can get to around 2% inflation.
Yeah.
About 1% of a real Fed funds rate is about the right level of pressure. I still think it's going higher.
The chairman talked about a recalibration. We've had 3 meetings, 100 basis points of cuts across 3 meetings. Was that the recalibration? Have we had it now?
I think that's some of it. I think
You think that's only part of it?
Yeah, I think that's only part of it. It just takes a weak labor print over the next month or so. It takes a surprise to the downside in core PCE. One of those things to remind the Fed that this level of rates with a 4 handle in this economy that's come from 0 interest rates is still somewhat restrictive, and there's more work to do.
If you are just joining us, welcome to the program. 10 minutes ago, a 25 basis point reduction from the Federal Reserve. A sprinkle of dissent, but that's not where the headlines are. The headlines are in the summary of economic projections, released alongside the statement from the Federal Reserve, where they increased their forecast for GDP for 25. They took down their unemployment rate forecast. They pushed up their forecast for PCE, and they did this with interest rates, projecting rates would drop only to 3.90, when previously they were looking for 3.40. So the Federal Reserve essentially, for the median dot, has gone from projecting 4 cuts in 2025 to just 2. Off the back of that, in the bond market, yields are higher, the dollar's stronger, and equities are rolling over. On the S&P 500, we are down by 0.6%. To weigh in on this, Diane Swank of KPMG joins us now. Diane, you've had some time to pore over all of this. Let's start with those projections. Was that in line with what you were looking for?
Actually, it is, and I'm glad to see it. I thought that the Fed was going to, if they were going to do a quarter point, which was already priced into the market, that they had to scale back dramatically, at least by half, their forecast for rate cuts next year, which is what they did. And the disagreement within the committee is exactly what you would expect. There's a lot of debate right now about how close are we actually to neutral. And in fact, the new Cleveland Fed president was one of the ones that said we may be closer than you think. So it's not so surprising that she cast a dissent, even though it's her first meeting. It's also her last meeting to vote before we see Austin Goolsbee roll back onto the committee in January as a voting member. I think it's not surprising at all that there were 3 participants at the meeting that also agreed that they don't want so many rate cuts next year. The economy, they can do it without front-running any policies. Right now, the economy has come in much stronger than they expected. There's been upward revisions to both employment unemployment, and inflation's come in hotter, and the consumer is atlas to the U.S. economy and the world at this point in time, and that's important. I think it's also going to be really important to see in the discussion and in the minutes to this how much they talked about that consumer sentiment number that showed people buying ahead of price hikes and that hoarding activity, which suggests that perhaps inflation expectations are not as well anchored as they thought and have become a bit more moored in the post-pandemic economy.
Diane, your Illinois is the 5th largest state economy. It would be the 18th largest economy if it was a country in the world. And yet we perceive Illinois not flat on its back, but a much more diversified, struggling state. What do you see out there about the two Americas that you would tell Chairman Powell?
Well, I don't need to tell Chairman Powell anything because he spends a lot of time looking at both Americas. I think people don't realize how much time he spends talking to people who are trying to upskill themselves and get out of being paid by the government and get training, especially single women with children. I know how much he spends time. He doesn't want to spend time just talking to executives when he goes out to all of his regional visits at the Fed. He actually asks to see the underbelly, to see where people are struggling, what's really going on. I think what's important, I think about this in my own situation. My son, when I asked him what he wanted for Christmas, he asked me to donate to the homeless. And the working homeless are a real problem. And I think that is one of the issues that we're struggling with. And interest rates alone coming down are not going to change the supply of housing. That once was a single lever. We know that affordability has been bid up by a whole host of factors, including scarcity of labor and these recent disasters that we've seen, which are pushing up the cost of actually construction.
Because of this fragility, and Bob, I'm curious your thoughts. Some people are saying that essentially this is a hawkish tone, but this still is a Fed with a pretty low bar to cut again. That is the comment from Neil Dutta as he looks underneath the hood of some of the employment markets that Diane was talking about. Do you agree?
I think the bar was low. It got a lot higher because they're telling us they're rethinking how many cuts they have to do. And certainly by the time they meet again at the end of January, they're going to hear a lot more from the administration. And it's going to be the administration, not the incoming administration. And they're clearly going to have to model that and weigh that. So I don't think there's a pretty low bar here. I think it's gotten higher.
I'm really pleased you brought up Neil Dutta's note. If you go to the bottom of this note, Neil from Renmac, of course, there's an interesting line here on the incoming administration. There is plenty of speculation of what the Trump administration will do, but they have to actually walk through the door. The Fed ought to focus on the here and now. The risk is now that the economy slows and the Fed is passively tightening by doing nothing. And here's the kicker, I think the punchline. Curious that the Fed was about to cut 100 basis points and then all of a sudden stops as Trump walks through the door. Diane, how much of these moves, the change to the forecast that we're seeing, are about the incoming data since September, and how much of it is about expected changes to policy that will shape that data in the years to come?
Well, we do know that with the continuing resolution that they're talking about a fairly large increase in bailout funds for the affected states from the two hurricanes. That will boost growth at the beginning of the year, and it is inflationary at the same time. So that is sort of already baked into the cake. Are they doing scenarios? Of course they are, but they can couch, certainly, I think you're going to see Powell couch very much and be very cautious to say they're not front-running any policy. They did cut at this meeting. If they were front-running policy, they wouldn't have cut at this meeting. And I think that's what Powell wanted to say, even with the dissent, with this hawkish tone. This is sort of the perfect way for him to say, we're doing our job, we're looking at the data, it's coming in stronger, the economy's solid, and it justifies higher rates. Now, you always worry about what's going to break going forward. The administration coming in, they will have more information on it, but even tariffs take quite a while to kick in. They don't kick in overnight. And I think people forget about that, and we don't know what not only will the tariffs completely look like, we have ideas and we can model out scenarios, but retaliation will be designed to disrupt supply chains. That's very important, because when you're thinking about it that way, that is inflationary, and we're in a much more fragile supply chain environment, which we've already seen. Vehicle prices have already gone up again, just in response to the damages and the buying ahead of additional price hikes due to 2 monster hurricanes. So we're in a situation where we have much more fragile supply chains with the embers of inflation still smoldering. That's just not a situation you want to add fuel to the fire on. You want to keep the lid on inflation, and I think the Fed is still hoping to hit that soft landing. But a soft landing, really, they will not declare victory, and this will not be Chairman Powell that we saw a year ago, who was pretty jubilant a year ago when we were sitting in this exact spot. I think you're going to see a Chairman Powell that is cautious, optimistic about the economy, talking about the strength of the economy. That's why they're doing what they're doing. That's why the outlook looks like it is, not front-running policy.
Well, Michael, I got a 10-year yield moving, the real yield. The real yield was a 2.05, 2.02. All of a sudden, I'm popping 4 basis points, rounded up out to 2.13%. What does that signal to your bond market? What does it signal to business? Just to see the real yield buttressed up right against recent highs back 6 months.
It tells me that investors might have been tilted the wrong way coming into the FOMC decision, and they're unwinding some of that. We'll see where it closes. I'm pretty optimistic things will settle down. I think Diane said it correctly, that this is still a Fed that cut rates in front of incoming policies. So they must see something in the improvement in inflation that they like, and they must see something in the labor market that they want to make sure doesn't metastasize.
We'll find out more in about 11 minutes' time when this news conference starts. A special thanks to Dan Swonk of KPMG. I want to draw your attention to what's developing in the FX market and elsewhere. So we'll start in the bond market. Just a flavour of that. Yields up on the front end by 7 basis points. The 2-year back through 430. If you take that move, just push it through foreign exchange. What do you expect? Big moves in G10. The dollar stronger against absolutely everything against the majors in G10. Beyond that in EM, Tom, 2% move against Brazil.
2 against a -6. Well,
that's another 2%.
Each of them, but each of them are idiosyncratic.
On top of the 20 so far this year.
Yes, you got Turkish lira popping through 35 today finally, but they're each a different story. But as Damien Sassauer says, who's expert on this, it is a flat-out 6% depreciation in EM currencies. And John, I'm looking at the drawdown in the Standard & Poor's 500. I'm not using the Dow here. And the SPX we have a drawdown of a negative 1.5%. There's carnage out there.
Session low, we're down about 0.7% on the session on the S&P. Matt Lazzetti of Deutsche Bank joins us now. And we teased this one up, Matt, a little bit earlier in the program. We said Matt Lazzetti is looking for one more cut, said it was a close call for December, and then ultimately, you think they're done for 2025. Matt, are they getting closer to your world?
Well, yeah, I mean, you have to say that the dots move closer to that world today. I think really importantly within the SCP, obviously a lot of focus on the dot plot, but what drove that was this big upward assessment in inflation. They moved up their core PCE inflation forecast to 2.5% next year. That's closer to our own view. They moved up their core PCE inflation forecast for 2.2% in 2026. Really, it takes till 2027 really to get back to their inflation target of 2%. And then there was a big reassessment of the risk assessment around both the labor market and inflation. Risks to the upside of inflation, everybody kind of anticipates a move back in that direction, and there are much more balanced risks to the labor market. So it's a kind of an SCP from a forecast perspective and from a risk assessment perspective that looks a lot more like it did in June than September.
Matt, how much do you think this really is stemming from the data that we've gotten of late versus just a promised change in policies next year? In other words, is this, as Neil Dutta says, that they cut by 100 basis points and then Trump walked in the door?
I think a lot of this is just the incoming data that we've seen. You know, they marked up their growth forecast as everybody else has by about 50 basis points since the September meeting. They marked up their inflation forecast, just given the incoming data, by 20 basis points since the September meeting. Marked down their labor market forecast by 20 basis since the September meeting. I think the data since the September meeting confirmed a few things. One, growth is robust. Two, the downside risks to the labor market and consumer are less than they were 3 months ago. And three, there are risks that inflation is just stickier than many anticipated. Just to put into some context, core PCE ended last year at 3%. It's likely to end this year at 2.8 or 2.9%. That's very little progress over the course of this year, and they can basis points despite that.
Matt, Jason Furman just publishes up at Harvard teaching Act 10. His first sentence, Matt, is simple. I don't know why the Fed cut. Matt Lazzetti, why did the Fed cut?
I think it's a great question, and as it was kind of discussed, we thought that there was a lot of good reasons not to cut. I think when Chair Powell is asked this question, it's going to be a difficult one for him. But the way that I think he'll frame it is, they still believe that they were restrictive, and we still believe that they are as well, and that even with a 25 basis point cut, they maintain that level of restriction, and that they're still kind of being able to balance the risks assessment from a labor market inflation perspective at this point in time. So I think that'll be the argument at this point. That said, I think the signal from them is that they're not just on this regular cadence of rate cuts. They're not just kind of on a path, a smooth path down to a neutral rate that is kind of uncertain. That it does look like they are going to be pausing for a bit longer here, given their baseline forecast for the data. And that's in line with our own expectations, that the data flow, we think, over the coming months and then coming quarters will just not be consistent with dialing back more restraint.
Tom, I thought that was a great question, and I'd like Bob's answer, because honestly, I think that really is a key question, and it's going to be very difficult for this Fed chair to really answer. If you actually are upgrading your expectation for core PCE, why did you cut it all this meeting?
Yeah, and so Matt may eventually be right that this was the last one. As he was talking, I was thinking, boy, this is really reminiscent of 1995 when they had hike rates from 3 to 6%. Everyone thought they'd have to cut rates to 4. They did 75 basis points. That was it. 5 1/4, and then they came back shortly thereafter, starting to hike rates. You do look around, and you do see that actually the economy is doing pretty well. Now, there are things below the surface in the labor market they have to be concerned about. There is a 0.9% increase in the unemployment rate. You've never had that without a recession. We look at job gains and look at the 6-month moving average, 108,000. Haven't seen that since 2010. So why not continue to take a little pressure off of businesses and households?
Given everything we've learned in the last 24 minutes, does it make you more or less comfortable embracing risk this afternoon?
It makes me more comfortable. I think the Fed sees what we see, which is, hey, this is a pretty good economy. We'll see what policies look like. Let's find a place to rest for a bit. We're not going to break anything. And it could be with a couple more rate cuts, and that's it. Matt could be right. It could be here. We'll find that out by March.
Matt Lazzetti, what's the elasticity here? The Atlanta GDP statistic is 3.1%. Can this suddenly save Jerome Powell? Can we get a suddenly slower economy? Or do you really have to glide out to, say, middle of next year?
Look, the slower economy is something that we in consensus have been expecting for the past several years. It just has not come at all. You see the past several quarters, 2.8% growth in Q3, as you mentioned, Q4 tracking at above 3% at this point in time. Our own growth forecast is for 2.5% growth next year, but that's a deceleration relative to where we are. Financial conditions are easy. Credit conditions have eased, sentiment has improved. So I do think that this economy has substantial momentum behind it, and I think can give you strong growth outcomes. One thing I'm a little bit surprised about is actually their potential growth estimate remained at 1.8%. They've been talking so much about productivity growth, the supply side of the economy. I thought that would begin to manifest in a higher potential growth rate in their forecast. Didn't happen today, but maybe that's in the coming quarters.
Matt, what would you want to ask Jay Powell at a time when everyone's going to try to get him to comment on Trump policies and everyone's going to try to understand just how high the bar is to cut again?
Yeah, so I think, I was going to ask about kind of the level of restriction if they had 3 cuts baked in. But I think it's more about understanding how they're thinking about a few things in the labor market. Bob mentioned, some weakness in the labor market. I'd be interested in whether or not the rising unemployment today, they would view similarly to the rise through the summer. I think there's many reasons for them not to. Payroll gains are stronger, the quits rate has moved higher, the hiring rate has stabilized a little bit, job openings have picked up, but are they as concerned about this rise in the unemployment rate as they were during the summer? Second question, I think, is on shelter inflation. We did have this big downdraft in the latest print that went against Chair Powell, saying that it was going to be a very slow progress on this front. How are they just thinking about it over the next several months? I think is an important question for them as well.
Matt, there's one big problem I've got with this decision, and it's the words the chairman used in the last news conference. We don't guess, we don't assume, we don't speculate. That inflation forecast, Matt, are we sitting here and really saying that much has changed in 2 months that warrants the upgrade to that inflation forecast at the FOMC without guessing, speculating or assuming on what policy is going to do?
So our own inflation forecast is 2.6%. That builds in about 20 basis points from tariffs. So, they'd be a little bit more hawkish on the inflation front than we would be. Just going back to 2019, I don't think they're really building in tariff effects explicitly into the forecast as of yet. I do think that is factoring into the risk assessments that we see in the back of the SEP, where everybody kind of shifted back towards upside risks to the inflation front. But that should also make you worried to a certain extent. If their baseline is 2.5% without tariffs, it'd be even higher than that with tariffs, which are likely coming, and therefore they'd probably be taking out even a little bit more of those rate cuts that they were anticipating, which was already leaning in a hawkish direction.
No doubt you'll hear lots of questions about that about 3 minutes' time when this news conference starts. Matt, we'll let you run. Matt Lazzetti of Deutsche Bank, Neil Dutt of Renmac writes in, talked about him a few times already this afternoon. The Fed is prejudging policy. That's one view. That's Neil's view.
Yeah, and he's talking about the fact that there has been such a huge shift without some sort of massive change in the tone of the data. That I think people will disagree with. We have some people who say the data has come in a lot hotter. Nonetheless, they have a lot of things to explain in this press conference.
Bob Michael, are they speculating? Are they assuming? Are they guessing at the FOMC?
Do you know what? Their inflation forecast just struck me as frustration.
Frustration with what?
With the stickiness of inflation. It should be 1.9 to 2% by now. Look at how the labor market has loosened up. Look at how growth has slowed down. And here we are, still around 2.25 to 2.6%. I don't read anything into it more than that.
So basically, do you think that at this point, this is a Federal Reserve that basically really is just throwing darts at a dartboard?
I think they have to be because they don't.
Well, that's essentially what he's saying, but carry on.
They don't know what. By the way, back in 2009, they would have forecast 2.25 to 2.5 because remember they had the flexible average inflation targeting. They wanted higher inflation for a period of time, and that's what existed in '95 during the last soft landing. Now, they don't guess, speculate, but they model, and they've modeled
sort of
something.
Yeah, well, I brought this up to you on Hollenhorst. Let me bring it up with you. It's real simple. Are they going to stay on an ex-post method that they used for 400 years, or are they actually getting out front and predicting? I don't buy it. They got to be ex-post. They got to wait for GDP to crack, for unemployment to get to 5%.
Right now, they have the cover of both, don't they?
Yeah, exactly. I mean, they're just an ex-post machine. That's all there is to it.
Bob Michael, this was fun. It's good to see you, sir. Almost there, almost at the holidays. After this is like kind of it for many of you I know, going into year-end, for us included. Physically, I've said we'll be here.
Until the Red Sox were eliminated. Okay, that's my tradition. So that got me to May 10th.
Nice.
And still, thank you. So, I'm taking a couple days off. I'll be here next week to pick up the pieces.
Well, the chairman's here right now, so we should probably cross over down to Washington, D.C. and catch up with the chairman of the Federal Reserve, Chair Powell, after reducing interest rates by 25 basis points.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides. Of our mandate. Economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive. We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Gina Smiley with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability. We see the risks as two-sided: moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Howard Schneider with Reuters, and thanks for the opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecast at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation to as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, it considers situations in which it might be appropriate to see through inflation, and then names some conditions in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect, tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work, all of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow-up. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers. So we have inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way. but it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to infer that?
So that's not any decision that we've made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points, so it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And I just would emphasize the uncertainty, which is it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts, included the phrase we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence, or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates, and we made look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. You do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
Colby.
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So but you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive? So
what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation is moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has, in recent months, been moving sideways in the 12-month window. And so we've got to weigh them both. And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are, we think, are broadly, roughly in balance. And so that's how we think about it.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I think I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really aren't balanced, and we need to see progress on inflation, and that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significally because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman, and thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggles with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
I don't think so, no. I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation. And that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and we want to keep it that way.
Thanks.
Amira.
Thank you, Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market. Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So, I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted. We've managed to have the unemployment rate remain essentially at its longer run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty good outcome. Why hasn't it come down? One reason is that just a technical issue around the way we calculate housing services, and that process has been slower than market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal, and people really feel that. And it's prices of food and transportation and heating your home and things like that. So there's tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning, big real wage increases, so that their wages are going up, their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Thanks, Chair Powell, for doing the questions. Edward Lawrence from Fox Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes, where is that neutral rate?
So I'll say a couple of things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given time, various shocks are hitting the economy. And so what we're doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy. And particularly, we look at the effects it's having as we try to move the economy toward maximum employment and price stability. And the answer can be, there are things that affect the economy that are lasting but not permanent. And the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away over time, they could actually affect what's sort of technically the appropriate neutral stance in near term. So we're looking at that, and we don't know exactly where it is, but as I like to say, we know it by its works. And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it, and I think we're in a good place. But I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is, because at the moment it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation, because policy is still meaningfully restrictive.
Victoria.
Hi, Victoria Guida with Politico. I just wanted to make sure I understood what you were saying at the beginning about inflation. Are you saying that progress on core PCE counts as progress on inflation, even if headline inflation ticks up? And then also, since that's what's projected in the SEP, I was wondering what accounts for that? Why do you all see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation because that's what people experience. People don't experience core inflation, they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is likely to be because it's a better measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline, not core. So your second question was what?
Why do you all see core going down but headline potentially ticking up?
So headline can be affected, you're talking about next year.
Mm-hmm.
Yeah, so headline can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. That's why the two can go in different directions. Headline has been lower, as you know, most of this year, but that's because energy prices have been coming down, which is a great thing for people, but energy prices will come down and they will go up, and it won't really be telling us anything about how tight the economy is and how future inflation will perform.
Do geopolitical risks factor in at all to how you're thinking about energy prices?
We monitor geopolitical risks really quickly, but really carefully rather. But I would say so far those risks haven't really. Nothing has come out of those risks that has really been important for the United States economy. The single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of global supply conditions. So the U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that wage growth is outpacing inflation now. It wasn't the case for some time, of course. It's partly why Americans haven't felt much relief in their wallets from prices yet. But with inflation ticking up, how worried are you the progress in closing that gap could go away?
Yeah, so inflation, again, we don't react to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation, and it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction. Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that the same kinds of things are happening. So we keep a strong labor market. Housing services inflation comes down. Goods inflation settles down, and non-market services return to their prior level. All of those things should happen over time, and those pieces come together. There's every reason to think that they will. The timing of it is highly uncertain. But you're not wrong though that it's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track, and I think if 2 years ago you'd said we were at 4.2% unemployment and 2.8% inflation, people would say, "I'll take that." I mean, that's a pretty good interim place to be. Job's not done, but I think we're feeling good about where we are and where we're headed.
Go to Nancy for the last question.
Hi, Chair Powell, Nancy Marshall-Genzer from Marketplace. You said a couple times inflation has been moving sideways. Appears to be settling in around, 2.5%. Do you think the Fed is just going to have to settle for that and accept that you're not going to get to your 2% target?
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That is, and I am confident we will achieve that. It has taken longer, but you have to be. We are making progress. We have made a great deal of progress, and we'll continue to do so, and get back to 2% inflation. That's what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
You don't rule things completely in or out in this world. That doesn't appear to be a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
That right there, arguably not the Federal Reserve's finest hour. After reducing interest rates by 25 basis points straight out of the gate in that news conference, asked an obvious question. Why do this when you're expecting inflation to remain above target? The chairman acknowledging today was a closer call, that we cut interest rates by 100 basis points across 3 meetings. The recalibration phase is over. We're in a new phase. Things are foggier. They're darker. You move more slowly. Well, this was the price reaction to that in the market. Equities slammed, down 1.5% on the S&P, on the Nasdaq down by more than 2%. The small caps, some outperformance on the small caps going into the decision, real underperformance coming out of it. The small caps down by 2.8% in the bond market. Big move at the front end of the curve. Yields up across the curve, 2s, 10s and 30s on a 2-year, up by more than 10 to 434.82. And off the back of that, in foreign exchange, as you might expect, the dollar stronger against everything in G10, ripping up EM. Euro dollar breaking down through 104 and threatening to do the same to 103. Euro dollar right now at 103.64. We all had questions about the forecasts. Why have you bumped it up on inflation? Why are you projecting higher inflation than you were projecting back in September? Why have you reduced the number of interest rate cuts from 4 to 2 in the median dot for the dot plot in 2025? Is it about the data, or is it about Donald Trump? Take a listen to the chairman of the Federal Reserve.
Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecast at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
Compare and contrast that to what you heard from the chairman back on November 7th. We don't guess, we don't assume, we don't speculate. December 18th, some of us guess, some of us assume, and Lisa, apparently, some of us speculate.
The WKEY is doing a lot of heavy lifting at a time where clearly he's reflecting a splintering committee that is dealing with a whole host of different outcomes and potentially political leanings. And I just want to go here. This is going to be viewed through a political lens, inevitably. It already was threatening to do so. Now there are some people who are incorporating highly conditional estimates. I wish that we had learned more about what those estimates looked like and whether they all were inflationary or whether some of them were to slower growth.
Neil Dutta wanted to jump onto the program. We can bring him into the program right now. Neil Dutta of Renmac. Neil, is this Federal Reserve on a collision course with the incoming administration?
I mean, it certainly feels like they're tempting fate. Powell's talking about, he goes through a litany of indicators talking about how the labor markets are cooling, and then he, in the same sentence, basically talks about how they're dialing back rate cuts. So I think that's a problem. And, I think the optimistic take around this is by making the forecast adjustments that they've made, they're actually, in some respects, lowering the bar for additional action, early next year. So, like 2.5% on core inflation, that's a reasonably high number. And, given what we know about rental inflation, that's probably going to slow down. Given what we know about, consumer goods, if you look at things like freight rates, it's probable that consumer durable goods prices moderate, over the next couple of months, just as the new administration's coming into office. So, I think they're signaling a pause, but it's also important to remember that by March, the forecast might look a little bit different, and they may have to cut again.
Neil, you were my economist of the year 2 years ago. You were optimistic when few were. Now you've switched, flat out switched. There's no other way to put it. How off is Atlanta GDP now at 3.1%? Does Powell know something we don't know, and those visible present numbers are just flat out wrong?
I never think, I don't think the Fed really has an economic forecasting edge of any meaningful degree. Tom, the Fed doesn't have a GDP mandate, so it's interesting to see how much Powell was talking up gross domestic product, private final, domestic sales. I thought that was pretty interesting, quite revealing actually, because that was sort of a way for him to avoid the questions around the labor market. And we know that duration of unemployment, as an example, has gone up by 2 to 3 weeks over the last couple of months. Leaving that aside, you're right. I am more cautious. I remember 2 years ago, around this time, the consensus was conditioned for, basically everyone was penciling in recession, and all I did was point out the fact that the labor markets were fine and housing stocks were moving up and to the right. Fast forward to today, it's literally the opposite situation. Everyone is sanguine on growth. It's very difficult to talk about recession. No one really wants to hear it. And at the same time, we know that the labor markets are slowing by Powell's own admission. Okay, and just pull up a chart of home building stocks.
Well, meanwhile, Neil, I just want to point out the fact that other people are taking a different tack than you are. As you say, you're contrarian, thinking that there's more weakness in the market. Peter Scheer saying this. He doesn't think it's necessarily political. He said this is a Fed that is worried that inflation isn't coming down fast enough, and while it might play in the back of their mind, they aren't responding to fiscal potential policy. On the margins, some are, but he's saying in general they are not. Why do you disagree so fundamentally with that?
Just go through the document. Look at the balance of risk to the inflation forecast. It's a dramatic increase.
Oh my god. What a day, man. What a day. Let's see. What a day indeed. What a day. 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 This is like... Now, this is an example of a freaking squeeze. Jesus Christ. You're talking about this stock being at like, what, like one and change? $2? I don't know. Wait. Let's see. Hold on. Oh, yeah. Wow. Talking about somewhere right between 140, 150, 160. Yeah, how about that, man? Can you imagine getting in here Monday, knowing the fact that you would have made an apparent 5,000% gain? Apparently, this is what I'm calculating right now. Did you see that? Did you see that? You see how crazy that is? How crazy is that? Oh my goodness. What's up, Kenneth? I'm back. Once again. Once again. Once again. What is, like, for real? I mean, look at this. I wish, oh my god, I wish I would have been able to pay attention to the Discord early this morning. I can't get over it. I can't get over how this stock, Nucleus, went off. Let's see, what's the latest with this stock? Nucleus shares quadruple in continued surge after defense deal. Nucleus shares recently traded at more than 40 times, maybe 100 times at that since Monday, continuing to rise after the fintech company's Tuesday announcement of an acquisition that supports a pivot towards the defense sector. So the stock ended Monday at $1.39, $1.39, and closed at $11.88 Tuesday. It was recently up 370% to $55.86. The stock was briefly paused for volatility at least 20 times today. 20 halts. Goodness gracious. Nucleus, which has focused on the cryptocurrency market, said Tuesday it bought a 51% stake in Star 26 Capital Inc., which is a defense acquisition company that holds 95% ownership in Ryman. Ryman's operations include supplying components for Israel's Iron Dome missile defense system. What? Wait a minute. Did I just read that correctly? Ryman's operations include supplying components for Israel's Iron Dome missile defense system. Our acquisition of Star 26 and Ryman aligns with our strategic pivot to capitalize on opportunities in the defense sector, which has seen rapid growth due to geopolitical shifts in the Middle East and the war in Ukraine, the company said Tuesday. Wow. So that's what this is all about. And of course I added on top here that this is what should have happened, which is what we're waiting for with AMC and GME, just as an example, okay? But this stock itself, like, holy, due to that news breaking, like, you're talking about, again, I measured this at around 158, let's say, for example, and at the very top here, I want to say the top was at around $77. That's your whole that's your whole squeeze right there. That is your whole squeeze. And imagine on top of that, options. If there were options available for this stock, oh my gosh, million, maybe like six figures. People with ports that made six figures would have been possible, in my opinion, of course. I mean, that's massive. It's massive. I don't know if it's actually going to continue. I don't know what the deal is, but that's what. Excuse me. I mean, that's what's happening. So supposedly, you got another stock that's involved in geopolitical tensions. What are the stats on FinTel for this stock? All right, so short interest ratio, 0.00 days to cover. So that's something familiar than what we saw with WKEY. If you guys can remember that one, and it had a huge rally, not quite as much as Nucleus, but I guess you can say WKEY had a little squeeze of its own. And it's funny because it did come back from a low of around 160, 165. And then when this thing ripped up from, well, I mean, this was long. This was a long time frame here. So this was at the bottom of, yeah, I want to say right around 163, 165, November 12th, and then holding from there till the peak, which went as high as 1401. In 33 days, that was a 747% gain. And of course, everything started to turn around from there and cool off. I mean, it exhausted itself, and then of course, like, it just needed to find a way to cool down and find the actual bottom, which in my opinion, it seems like, now that I look at this, right, you can actually see it slow down in the sell-offs. And you see there was one point where there was a point where, what is this? Is this 4 o'clock in the morning today? Yes, it was. So there was a little pop from 876 to about 11 and change for WKEY, and then I guess they started taking profit from there, or it got shorted, or both. And it's ended up falling all the way down to the bottom of, what was the low for today? 741. And a high of 960. So 960 is 741. And it looks like it's slowing down on the sell-offs, like I said. And I actually had put this, level here yesterday. And it seems like it's actually respecting that level. Right around 750, a little bit, it did go lower, but then it ended up catching up and then bouncing right off that support level at 750 and above. So right now it's up almost 2% in the green post market. and it's at 784 from a close of 770. So it's kind of like, okay, well, it looks like it finished exhausting itself and cooling down. Now it's trying to bounce off. In a way, I think, in my opinion, that the way the stock traded was not affected at all from the FOMC rate cuts. So it's acting on its own accordingly. Not financial advice. Told my son to try to get XRP to 232. Wow. Looks like Bitcoin is trading just under the $2 trillion market cap. It was at a high of 2.15 trillion in market cap, but this whole sell-off from Tuesday morning, from 2.14 trillion to now 1.99 trillion. That's a lot of trillions. Well, actually no, that's no, what I meant to say, that is a lot of billions. A lot of billions. So if you were to count, let's see, so if you were to count from here, so 13, 14, 15, 16. So Bitcoin probably erased like 15, 16, 17 billion dollars worth of its market cap. So imagine that. And then the SPX, man, what a reaction. We did not expect such a drastic dump after the release of the Federal Reserve's decision to cut rates at 25 basis points. This is, something is definitely wrong about that picture. What they think that cutting the basis points by 25 that was gonna hold the markets? Because I feel like, in my opinion, he's just playing the same song all over again, like he has been for every other meeting. And quite frankly, it looks like, from what I said before, yeah, it looks like people are catching on to the BS. Again, it's the same song being played, same lyrics, nothing has changed. They want to hear what they really want to hear, and it's the truth. And, it's either this is only the reaction and then a recovery for tomorrow to probably try to retest, and maybe let's just say maybe it heads back up to 590 and then try to face 590 as a resistance, and then you have now 583 as the new level of support. So I want to say maybe you'll probably try to somehow play with this range until it actually continues to sell off. And then by the time you know it, before this year is over, you have the SPY somewhere around between 575 and 580. And how about that for a Santa rally? You might as well just call that an inverse Santa rally, because this rally is different. This rally is no joke. No joke. So I'm quite surprised what we just saw today. And I don't know, in my sentiment, I think we're just getting started. As a matter of fact, when was the last time we even had a close to negative 3% on the day for SPY? Let's find out. Holy moly! Would you look at that? Wow! It sort of retested this last low here from November 19th. That is a nasty drop. Literally erased all of its gains from November 19 at a low of 581 all the way to that all-time high of 609.07. Gone in one giant daily candle. That $600 level destroyed in one shot. And now looking for the next target, if it continues the way it is, to, who knows, maybe potentially 567, 568, and test that. Or maybe around 565. So those are gonna be the levels to look at for now, before this week is over. Who knows? Maybe we can see this continuing into next week. I am still bearish on my sentiment, regardless, and not only SPY, but Bitcoin too. And you know what? I still have, and I'm that type of person that it's like, if I'm wrong, I'm wrong. But I'm still leaning towards my sentiment regardless, and that's why I released that video a long time ago. When was that video? When was this video that I made? I'm just checking real quick here. When was it? 2 weeks ago, actually. Was it 2 weeks ago? Yeah. Okay. So I think it was like somewhere around 2 weeks ago, where I did this graph, and then I made these supposed levels. If there was ever gonna be, a correction, and how, because I, pretty much mentioned how everything is tied up with crypto. If there was a huge correction, how many times I'd said something like that, and as an example of what happened today with FOMC and the reaction of the markets, and look, big 24-hour candle for Bitcoin as well. Because why? Because it followed the market. It went with the sentiment. It went in the reaction of FOMC. It's pretty much the same thing. It pretty much is. And if we break below 100,000 into overnight, into tomorrow, these levels are going to be like, I'm telling you, they're gonna have to be retested and broken down, and then my 85,000 price target would be met, and then after that you got 70,000. That's not financial advice, for real. For real. I mean, look at the way that this this ascending triangle played out, or wedge, or whatever you want to call it. How it just managed to retest and then just drop right below. I mean, you might as well call this. No. Could that be the wedge? No. I guess we'll just leave it the way it was before. It still played out. I'm just gonna say it still played out no matter what. And now we're just waiting to see the end result of all of this and what's gonna happen before this week is over. Will we lose 100,000 tonight and continue to fall tomorrow and Friday? That'd be great. This counts for everyone. And that includes all crypto, in my opinion. Including XRP. What's down by a lot right now? Of course, the meme coins. What do you got? You got ELON. ELON that's dressed as Doge. Doge ELON. Down 15%. Got KISHU. PEPE. You got BONK. I just got bonked for the past month or so. Here November 19th and 20th. Just kept getting bonked. All the way down here. This 4-hour chart. Where is it? Where's the what do we have here? I guess it's following this channel here? Maybe. I don't know. Oh, no. Crow. We got Crow just topping off. Or, I mean, like, imagine if all of the whole rally that took place after the elections, right? The whole rally that took place during the elections, and so forth. And we're just topping out, knowing the fact that now we're potentially facing a massive correction. In my opinion, of course. And then all of a sudden, all of those gains get erased like it never happened. So hopefully a lot of people had taken advantage of that rally, election rally if you want to call it, and made their money on the way up. Financial advice to now, because now you're seeing the trend line from this trend filter, and now it's red. And even here for this indicator, now it's turning back down in the top reversal. What else is down? Let's see. That's that GME coin. Well, now you got XRP at $2.33 from a high of $2.90 on December 3rd. Looks like a double top too. So I don't know what you guys think, but no bueno. Look at that Dogecoin. Dogecoin getting dismantled, getting smacked. Now back down to 36 cents. From a high of 39 cents. It was at 39.40 cents before. Day before. Now it's at 36 cents. What else? That's it. All the coins on here is completely red. I think NUKK is finally selling off. Yeah, look at that. Massive 5-minute candle here that just took place. Last 5 minutes. Completely 8.15K shares traded on that 5-minute candle. Somebody was like, All right, I'm out. I'm taking profits. Blah blah blah. Candace. Oh, no, I read that. So your son has XRP at 232. Kenneth says next few days will tell which the markets are headed. If you look back at the SPY or the SPX, let's go back to the daily real quick. We did started seeing more lower lows. Like you could just tell, like every top that it would try to make, it would be lower and lower and lower, and then from there it just pooped on itself. Maybe a lot of bulls were expecting some type of a pennant, and then maybe a breakout for FOMC. But then, that completely failed. Completely failed. That is just disgusting. And you know what? There's still more gaps to fill. So it's not only there. You still got all of this to worry about. For the SPX here at 5,809, 8,010. Fill that gap. Actually, you know what? The gap even continues even lower, even under 5,800. So then that would have to be the next target. If this downslide, or I don't know, what do you want to call it? But I guess you want to call it capitulation. That's where it could possibly reach, in my opinion. So that's that. But what I was talking about before, yeah, I mean that's probably going to be the next direction. KULR is actually, wow. So KULR actually managed to come back up, and now it's up 10.5% in the green, and they're probably going for another round. KULR, with the news that their company has regained compliance with the New York Stock Exchange American listing standards as of yesterday, after meeting equity requirements for 2 quarters and resolving all deficiencies. That is really healthy and, in my opinion, bullish. And we had been talking about KULR for a couple of months now. I want to say we've been talking about KULR since it was around 40, 50, 60 cents. I want to say even way before the elections time, we were discussing KULR for a while, and I forgot who it was that brought to my attention. I don't know if it was Mark, but whoever it was that brought it to our attention, shout out to him for KULR. And just to see like what would happen afterwards. That's pretty exciting to hear that the company has regained compliance with the New York Stock Exchange. So who knows if that could be just the beginning for them, and for more growth ahead. You got Archer too, trying to come back up from its little rally that it had today. Low 876, high 1058, which is now Archer's new 52-week high, $10.58. Wonderful. Mm,
Pero tú lo votaste.
Pretty sure I saw a drone flying in Nashua, New Hampshire. Oh boy. What's up with these drones now? Everybody's seeing that. Huh. Unbelievable. No more days to cover. What is funny is that for WiseKey, randomly here, I'm just noticing it had been 5 days since FinTel had reported their numbers. Short interest, short shares available, cost to borrow. Literally, like there's no update at all. Just looking at what's going on, and yeah, it's pretty strange to me how they're not disclosing that information, you know? So right now, currently, WiseKey just neutral, just flat right now. What else happened? What other stocks got attacked here? Let's see. Okay. Micron Technology took a beating after earnings, including the reaction to FOMC, so it definitely made things worse, as it came from a top of $112.04 to a low of 102.73, to then get smacked down all the way to $85.57. Can you imagine that? That is a big drop. So, you know, and even though it says here that they had beat their estimated earnings, the revenue was down by 0.06%. It got a lot of work to do. So I mean that's SYPR. Wow, I did not know that SYPR Solutions was also running. Wow. Me voy de este país. Me voy de este país. Also, other reactions from FOMC, as the dollar index. The dollar index just ripping high, and causing the dollar index to rise dramatically after that reaction, hitting a 2-year high after the Fed delivered that announcement. But let's talk about that real quick too as well. So, FOMC cuts funds rate 25 basis points, strongly hinting at rate cutting pause. So I think that's where the market reaction came in, and people were like, "At what WTF?" And like, what are the odds of him actually pausing, like actually just keeping it the way it is for next month? So after 100 basis points of cuts, policy rate closer to neutrality, and now appropriate to ease more cautiously, slowly. All these words that have been just coming out a lot recently, like cautiously, slowly. And they really don't want to miss a step and mess up everything and potentially just crash the market at the same time. But yeah. Unbelievable. So what I was gonna say, because of the fact that the dollar index surged so much, you also have precious metals here also falling down, and silver and platinum and palladium and copper all came down at the same time. So what did that do? I mean, that pretty much left precious metals bringing down those miners at an actual cheaper price, in my opinion. And how thoughtful. I mean, wow. Let's see, where is that list at? I know I had that list somewhere. Where is that? Okay, here. So EXK in the 5-minute seems to be bouncing off at 3,070 cents. Could be, in my opinion, possibility of a buying the dip target, and for silver to come back around and start moving back up. If not the end of this year, maybe next month or so, see some interesting movement with precious metals. But as you can see here, EXK here, last high at 456 back in December 9th. So, but anyways, yeah, just wanted to go over some of the things here. Unfortunately, and I hate to do this, but I am getting sleepy as hell. I had a long day at work, 9 to 5, and also I did Uber Eats on the bike, on a regular bike, Monday and Tuesday evening. And I'm trying to fight to keep my eyes open, but I'm just going to have to take that nap. So, by all means, guys, I know it's a bit abrupt, but I want to go ahead and just take the time to thank everyone who joined today's stream this morning. I know things have been a little bit hectic, pretty, in terms of scheduling and all that stuff, and how I wish that I could just not work and then just being able to do this with you guys and just actually have the full attention of everybody. So, but I know that one of these days it will eventually happen, and we'll have a day where I can get to stream all day talking and spend time with each and every one of you, and just chill and talk things, share interests, share experiences, trading and stuff like that. And I know eventually it'll happen. So that's my take on that. And again, everyone, thank you. Much love. I appreciate your vibes as always. Thank you for your support, the love. And And so I'm gonna leave it at that. I want to thank everyone who joined. A big welcome to Ron S. to the channel. It's the first time I've seen him in the chat, so shout out to him. Shout out to Ron S. Gabe, Kenneth, Johnny, Moisley or Splat, Johnny, Eric, TP, Zelly, Jesse, Gary, if I'm missing somebody, let me know. But everybody else who joined, and I'd like to thank you all for the love and for being here and for the vibes. I do it for the vibes. So, and also everything that was said on the stream, on chat, was just strictly in our opinion, not financial advice. It's just for educational and entertainment purposes. So remember that you're your own decision maker of your own money and your investments and what you do. Just remember to, know your limits, set your limits, know your risks, and as long as you're making money, as long as you're compounding those gains, that's what truly matters. And I really wish you all best of luck tomorrow, the rest of your night. Have a great night, and we'll see what happens tomorrow to see if this is indeed the inverse Santa rally, and that we are possibly seeing the end of a bull market, the end of an era for the SPY. In my opinion, as we know it, the beginning of the end, the market crash of it's just my imagination, I guess. I don't know, but maybe the beginning of the market crash of 2025, and margin calls to come, and a whole bunch of squeezes, and Amy and Jimmy and Lucid and all the others. Stay tuned for the next in Lion's Den with yours truly, Lineable Trades. Chris, shout out to you. I'm sorry it's been abrupt, but it's good to see you. Thankfully, you were able to catch the last moments of the stream. Wishing you a great night. Hopefully you did very well today and tomorrow and Friday. Good luck and take care. Peace out, bro. And peace out, everybody. Ta-ta!